First off, a big disclaimer. I am not a financial advisor, so before you make any big financial decisions, consult with a professional. Last time, we learned about interest rates, compound interest, and how important it is to pay off high-interest debt. In this episode, we cover inflation, emergency funds, and I give some suggestions on how to invest so you can make money in your sleep. Inflation. If you look back over the past century, inflation has ranged anywhere from negative 10% or deflation all the way up to 20% inflation. Inflation has been fairly low and stable over the last few decades, but that's no guarantee that it'll stay that way forever. So whenever you think about interest rates, you should always be thinking in terms of real returns, which is the rate minus inflation. For example, if you're getting a 5% return on an investment, but inflation is 3%, then your real return, your actual growth in spending power, is only 2%. On the flip side, if you're borrowing money at 5% and inflation is 3%, then your true cost of borrowing is only 2%. So as you can see, it's a little bit tricky managing real returns when inflation and interest rates are constantly changing. So pop quiz, you have $200,000 owing on a mortgage at 5%, and you have $10,000 in a high interest savings account at 2%. Should you use that money in your savings account to pay off part of your mortgage? So this was actually a trick question. Strictly by the math, you're gaining an effective additional risk-free return of 3% on your 10 grand if you use it to pay off your principal, assuming that you don't get a penalty for doing so. That means that strictly by the numbers, it's always better to pay down debt. However, that brings us to step 4 on the road to financial independence. Before you go emptying your savings account, do you have an emergency fund? Unexpected events like losing one's job, unexpected car or house repairs, or let's say a global pandemic can eat into your cash reserves very quickly, and you don't want to have to borrow money at credit card interest rates. Having an emergency fund helps you weather financial storms. So you should always have enough liquid assets, so that's cash or cash equivalents, to cover between 3 to 6 months of expenses. So now that you've cut your expenses, maximized your income, paid off all your high interest debt, have a 3 to 6 month emergency fund, you are now ready to start investing and making your money work for you. Remember the light side of compound interest? It's time to put all that to work so you can literally make money while you sleep. The best investment portfolios tend to be built from a combination of high-risk and low-risk investments. If you know you won't need a chunk of money for 25 years or longer, you can pretty much just stick it in a stock index and be confident you're going to get maximum returns over that time period. However, if your horizon is 5 years, then putting it in the stock market is a huge gamble. So your risk allocation needs to change based on your investment timeline. So what type of investment should you buy? For a lot of people, an all-in-one ETF will be the best solution. These are similar to mutual funds in that they package up a whole bunch of stocks and bonds to reduce the overall variability and risk, while providing a good return and low fees. In Canada, the 2 main vendors of these types of ETFs are Vanguard and iShares. They offer anything from 100% equities or stocks to a very conservative mix of 20% stocks and 80% bonds. For example, the balanced portfolio, VBAL or XBAL, provides an allocation of 60% stocks and 40% bonds. Whereas the growth portfolio, VGROW or XGROW, provides 80% stocks and 20% bonds. Once you have your meat and potatoes investments, then you can start adding in some flavor, some higher risk assets such as individual stocks. For instance, me being a techie, I often had some tech stocks that I think have the potential to break out. Gold is something else you can look into. It's a hedge against inflation and bad economic times. And one of the more interesting ways to invest in gold is to buy an ETF of companies that mine gold. And being in technology, I have to mention Bitcoin. Bitcoin is a super risky one, and I only recommend purchasing it if you understand the underlying technology. And even then, I would estimate a 50-50 chance of it eventually becoming worthless, so it should never be a large part of your portfolio. And be careful. Once you reach a certain risk threshold, you're basically gambling, and you don't want to be gambling with your future financial stability. You can take higher risks if your financial horizon is long, but you still don't want to take your life savings and bet them all on black. Finally, the big question: how much do you need to be financially independent? Well, quite a lot, as it turns out. If you want to live completely off low-risk investments, you can follow a general guideline called the 4% rule. This just means that with a well-balanced portfolio, you can usually withdraw up to 4% per year indefinitely, forever, without affecting your capital. For example, if you have $1 million in your portfolio, it means that you can withdraw 0.04 times a million, which is $40,000 a year in perpetuity. This also factors in inflation, so it assumes that you're getting at least a 4% real return on your entire portfolio. Conversely, if you know that you're going to need $100,000 a year, you can calculate your required portfolio by dividing 1 by 0.04, which is 25, and then multiplying that by your yearly expenses. That means if you spend $100K a year, you'll need a portfolio of $2.5 million to generate that amount in perpetuity. That's why reducing your expenses is such a crucial step on the road to financial independence. In summary, every situation is different, but to achieve financial independence, there are still the same 5 basic steps. Number 1, reduce your monthly expenses. This is covered in earlier videos. Number 2, increase your monthly income. This is going to be covered in future videos. Number 3, pay off all of your high interest debt. Number 4, build an emergency fund. And number 5, build a suitable investment portfolio that matches your timeline and risk objectives. See? It's all very simple. For more on this topic, be sure to check out our other roaming finance videos.